Brad, pleasure to speak to you. It's very good to have you here today. Your head of debt is a very hot topic at the moment. How is the market looking like? Not much transactions, but what about financing?
It's a very challenging and complicated market, but it's still a very liquid market. What we're finding is not that there's a liquidity crisis, but it's a cost of capital crisis, which in turn does have some impact on the liquidity and the availability of debt. What we're starting to see is more and more alternative lenders come into the space. We're seeing more structured solutions with preferred equity and with other sort of debt instruments that are allowing people to refinance in a very challenging market. But what we need to see is the acquisition market pick back up. And for everybody, that is the foundation of the transaction market. That's where lenders want to lend because you have a new base value, you have fresh equity, you tend to have a better understanding of the business plan, and ultimately that's where the capital on the equity side wants to go. But we have been in this moment in time for the last 6, 12, maybe 18 months where there's a lot of uncertainty, which hopefully now with the underlying index rates starting to level off a bit, there is some certainty.
That was my question to come now. What's the forecast for the next 6 to 12 months? Do you see any change coming, and how fast can we see that happening in Europe?
I think rates are starting to level off globally, which is good. There's probably still going to be another increase in rates from the U.S. Fed to come in the next couple of months, but it's not going to be as dramatic as you've seen over the last 24 months. So the wider market has now got accustomed to higher interest rates. It's not going to go back to zero. The forward curve will show that it will go down eventually, but you're talking about 3% versus sub-zero interest rates, which means that there's still going to be a pretty significant cost of debt to what we've seen. But once people get accustomed to the levels of debt, the market will ultimately reset. And at the end of the day, funds are closing, people need to dispose of assets, transactions need to happen. But people in uncertain times don't tend to transact. So hopefully we get to a point in a very short order where there is certainty and people are comfortable to transact.
Is there anything that would keep you up at night at the moment?
Yeah, I would think that people putting too much debt on assets to try to buy themselves time, especially at the cost of debt today, is probably going to create issues in the future. Debt is a great instrument until it's not. And we saw in the global financial crisis, debt within real estate was one of the biggest issues that ended up bringing down the global economy. So as long as people are being smart around using debt and not using it as a financial tool to try to buy themselves more time to avoid going into insolvency or foreclosure or selling assets, then I think we're going to come out of this okay. But what does scare me at night is that people are looking at taking debt and or they're taking mezz or pref equity to buy themselves time, but in reality, the cash flows can't afford putting that much debt on the asset.
And what do you know now that you didn't know a year ago?
I would say that people really, really, really want to be in the credit space. If you talk to all of the equity groups a year ago, I don't think there was as much pressure to come up with creative ways to deploy capital. Now, everybody that you talk to within the equity space wants to try to do credit. If you talk to any of the big private equity funds, the asset managers, the sovereign wealth funds that don't have credit programs, the first thing they'll tell you is that we're trying to do credit, which is great for the liquidity story within credit, but it's expensive because it's still equity-like returns, and these groups have minimum returns. So I think a year ago, the biggest question was, are there going to be these pref equity structured trades at a mid-teen sort of return? I would have probably said no. We're probably not going to get to that level. We're there. I mean, we're starting to see some pretty meaningful trades with meaningful sponsors that are taking the 15% money that a year ago they probably wouldn't have taken.
You overlook the entire market, and when you look at the situation in different countries, what's the country that's in best shape compared, in better shape compared with others, and what's the country that maybe worries that would worry you the most?
So the great thing about the continent versus the UK is that base rates are lower. You're also getting a pretty good FX pickup for euro-denominated trades versus Great Britain pound trades for international investors. So Europe in general, in terms of the overall cost of capital and cost of debt, is in a better place than the UK. The country that we've been the most active in has been Spain. We've seen Spain be a huge beneficiary within the hospitality asset class and really benefiting from that. And we've seen a lot of international capital sources going in to Spain. Mm-hmm. The country where I think there's the most opportunity is France. I think France has been very, very well banked. It's been very insulated for a long period of time, but you're starting to see the local banks pull back, and you're starting to see a lot of the international banks come into France. Same thing is starting to happen in Germany. So those are the two markets where we are the most focused, where we haven't been as active historically, that we think there is a great opportunity. But there's really not a country where we think there is going to be a huge amount of distress. I mean, Germany for so long had such low rates and such tight yields that there is probably going to be the most distress in terms of core office assets that people are going to have to trade out of or be smart around. But we think all of the markets, are positioned very well to take advantage of what the current dislocation is.
Brad, thank you very much for your time. Great to hear your thoughts.
Thank you for having me.
Thank you.